How are you all doing today? It is currently 33 degrees. Welcome to the first edition of Anthony's Insight. Topic of discussion, Credit Basics 101. Let's jump right into it, okay? For starters, why is credit important, all right? Your credit is your reputation. Once you mess it up, it takes some time to rebuild it. Your credit impacts virtually every aspect of your life, okay? Your credit score is also a direct reflection of what risk you are and how much you'll pay in interest. If you want a home or a car, credit, that's the first thing the bank will ask about. If you are looking for a personal loan or business loan, basically the same thing. What's your credit score is basically what they're going to ask, right? Homeowners insurance, car insurance, even life insurance, companies are now pulling your credit. Employers look at your credit, especially for jobs with any type of financial responsibility, will want to see that you, okay, are financially responsible, and your credit is the best way for them to determine that. Nearly every opportunity in life is affected by your credit. So in short, your credit is extremely important, is extremely important and impacts everything, okay? Here's a little bit of some statistics. Some interesting statistics regarding credit reporting. 79% of credit reports surveyed by USPIRG contained errors or mistakes. Over 61 million Americans have subprime credit scores between 350 and 649. Nearly 33 million Americans do not have enough credit to generate a credit score. 24 million Americans have no credit file. Most consumers have no idea how to get a copy of their credit reports. Incredible when you think about how much your credit impacts your life. Moving along here. Okay. Calculating credit scores. So what are credit scores and how are credit scores calculated? Credit scores are basically adult financial GPAs. Seriously though, your score is your financial reputation, and banks, lenders, employers, insurance companies, and others take your reputation very seriously. There are many different types of credit scores. Okay. Thousands of companies sell their own white labeled credit reports, and most use their own scoring models. So the score you get from that one place to the next will typically be different, okay? Regardless, the scores are intended to help you gauge how good or bad your credit is. But more importantly, it's to help banks, lenders, and other companies make complex, high-volume lending decisions. So let's discuss scores, okay, and how they are calculated. Now, the biggest chunk of your credit score, as we already know, is your payment history, okay, which is basically 35% of your total score. Late or missed payments obviously lower your credit score. In general, risk scoring systems look for negative events like charge-offs, collections, late payments, repossessions, foreclosures, settlements, bankruptcies, liens, and judgments. Within this category, credit scores consider the severity of the negative item, the age of the negative items, and the prevalence of negative items. Newer is worse than older. More severe is worse than less severe. And many are worse than few. Basically, not paying on time can devastate your credit scores. Debt is a huge factor and accounts for roughly 30% of your score. Scoring models consider the amount and type of debt carried as reflected on your credit reports. There are three types of debt considered, okay? You have revolving debt, installment debt, and open debt. So how debt impacts credit. So debt is the most important factor, I would say the single most important factor on your credit. If there is any piece of information you should remember this. Every dollar of debt you owe is considered a risk factor. The more debt you owe, the more likely it is that you will not repay it. And every dollar of debt will hurt your credit. That's right, every dollar, okay? Different types of debt have different impacts on your score. Revolving account balances hurt more. This is because they can be reused. Again, credit is a numbers game to my salespeople, right? And everything is a mathematical and statistical Okay? Credit scores, credit scoring models use complex mathematical algorithms that determine the likelihood of repayment, which in turn determines the risk assessment. Ideally, keep zero balances on your revolving credit accounts. Installment and secured accounts, on the other hand, hurts less. These may include homes, vehicles, or personal loans as long as they are not revolving like credit cards. They will have a lesser impact on your credit score. All right, let's move right along. Optimizing credit scores. Here are a few tips. Pay attention, guys. Here are a few tips to optimize and increase credit scores. You heard that right. Increase credit scores. Excuse me. Of course, you only want positive and accurate information on your reports. If you do not, your credit will suffer. Plain and simple. If you have mistakes, inaccuracies, or outdated information on your credit report, there is a way to fix, most of it. If you have negative information on your report, obviously you should begin repairing it. But there are also ways to minimize the items even if you are not successful removing them. First, make sure you have a good mix of accounts. You should have at least one installment loan and 3 revolving credit cards, but make sure you keep your revolving balances low. Pay down your revolving accounts, such as credit cards, first. Try to keep them either very low or at zero balances. Remember, you have to play to score. You have to play to score. If you do not use your revolving credit cards every few months, they may stop reporting. Yes, you've heard that right. They may stop reporting. Credit card companies pay to report your account information to the credit agencies. Accounts that are idle or show no activity will stop being reported. I recommend that you buy a small ticket item with each card about every 90 days to keep them reporting. So you can use your accounts, but keep your balances as low as possible. If you have been paying on time, most creditors are happy to increase your credit lines. Some of them do it automatically, some do not. Try calling each credit card company every 6 months or so and tell them that you would like them to increase your credit line. Your oldest accounts are your most valuable, okay? When it comes to credit scores, it's important to keep them open, even if they are, is a yearly or monthly fee. Consider keeping them open because closing an old credit card could damage your score. Yes. Another important tip is opening and maintaining new accounts that report to the credit bureaus is a key to building a solid credit rating. There are many different types of accounts that you can be approved for even with poor credit rating. Typically, you will pay a higher interest, higher fees, or may have to secure the account with collateral such as money or assets in order to open accounts if your credit is less than perfect. Credit history accounts for about 35% of scores, like I said before. Therefore, if you don't have sufficient credit history, you need to open new accounts and pay the price if you ever want to increase your score. We've covered a little bit about inquiries earlier and how they impact your credit. Each time you apply for credit, an inquiry will appear and can drag your credit score down a few points. So try not to apply for credit unless you are either trying to build credit or absolutely need something. Lastly, make sure your personal information is accurate and up to date. This includes name, address, previous address, social security, date of birth, and employment history. When lenders or potential employers pull your credit, they may check to make sure the information you placed on your application matches what the credit bureaus have on file. If not, they may consider you a risk because of it. All right, we are almost done here, guys. I'm not sure if any of you ever heard of this term before, but let's talk about it. Piggy backing, right? Now, there are 2 different ways you can piggyback. Okay, number 1, authorized user. Number 2, joint account holder. Each has its advantages and disadvantages. I'll explain what those are. Okay, Piggybacking is a technique that allows you to inherit someone else's credit history by being added to an account, typically a credit card. It can season your credit and increase your credit scores. When the general public caught on to this trick a few years ago, it spawned an entire industry to meet consumer demand. There are companies that you can pay to piggyback and complete strangers' credit account. That's scary, isn't it? They called these companies trade line dealers who paid credit card holders to rent out spots on their cards, but only as authorized users. Some credit card companies allow 20 or more authorized users, so these trade line dealers charge anywhere from a few hundred to thousands of dollars to rent these spots. The authorized user never gets an actual credit card, but the account will typically show up on their report. Eventually, the banks, lenders, and credit scoring providers caught on, and the scoring models shifted the weight of authorized users to minimize this practice. With that being said, authorized users on most cards do not carry much weight and have much lesser impact unless the primary on the account is a family member or a spouse of the authorized user. Important. There are many companies that sell trade lines. Stay away from them. Any person buying trade lines in an attempt to cheat or defraud a mortgage score may result in mortgage fraud, which is a felony and could result in jail time. Do not buy, sell, or partner with any trade line dealer or broker. On the other hand, if you ask a family member to help you, that is completely legal. Okay? So I'm just going to jump a little bit more into it, and I'm going to close. Here's how piggybacking works. First, someone you trust. This person must have a credit card account with a major bank in good standing with a low or preferably no balance. Also, you want to choose an aged account, one that has a long history. The older the better. And finally, the primary must be willing to add you to that account. Okay? Now, I say in good standing because you don't want to inherit a negative account, right? I said preferably low or no balance because if the account has high balance or is maxed out, it will only hurt your scores. Lastly, I mentioned you want an aged account. Why? The older the account is, the longer the payment history is, and that will help your credit the most. Number two, your friend and family member calls the credit card company and requests to add you as a authorized user to or a joint account. The credit card companies are usually more happy to add someone else to the account. So, should you choose authorized user or a joint account holder? That depends on a few things. Just try to remember this. Credit scoring models will place much weight on authorized users, will not place much weight on authorized users unless the primary is your spouse or family member. As an authorized user, you have zero liability. If the account ever falls behind, has late payments, or the primary maxes the card out, you can have it removed from your credit just as easy, okay, as it was to add it. Just call the creditor and ask them. They will remove you and remove it from your credit. Now, on the other hand, if you choose to be a joint account holder, you are permanently responsible for that credit card forever. It's really important that you make sure that the primary account holder is a responsible person and intends on paying on time and keeping the balance low. Otherwise, there is a good possibility that you will end up with problems. If the primary maxes out the account, it's late, goes to collections, gets a judgment, bankruptcy, you are equally responsible for it. Just as if you co-signed. Unlike an authorized user, you cannot simply ask to be removed. It's permanent. So be very careful, okay? Be very, very careful, all right? Number three, be sure to monitor your credit reports. Make sure it's getting reported to the credit reporting agencies. Provided you did everything correctly, this account should show up on your credit reports within 30 to 60 days. That is all for today, guys. I'm really excited that you joined basically Anthony's Insight on Credit Basics 101. I will be doing more videos. Thank you so much. Take care and God bless you.